You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
This weekend, just want to thank you for tuning in. This is the time of year in March where we start to think about the spring, and spring is in the air, and I know it seems like we're getting these temperature swings between warmth and cold weather, but we do start thinking about spring, and a lot of times we think about spring cleaning after the winter months. It's also the perfect time to refresh and rebalance our financial lives. The first quarter of the year so far has been rather eventful, as we've had these first couple of months of the new presidential term. Got a lot of controversy going on, a lot of volatility potentially. It's brought market movements that may have shifted your carefully constructed financial plans. So whether you're seeing investments that have outperformed expectations or areas of your budget that need adjustment in the months ahead, this is an ideal opportunity in the spring to assess where you stand and make strategic changes. Today we'll explore practical ways to rejuvenate your finances across several key areas, from portfolio management to personal budgeting, market outlooks. How might we be affected by tariffs? How might we be affected by the Doge layoffs? Let's put all this in perspective as best we can. So if you're wondering how to optimize your finances for the months ahead, you've turned into the perfect time, because here's what we're going to cover. We're going to talk about portfolio rebalancing, how to review and adjust your investments over time based on performance and market trends. And do we sometimes market conditions? Market conditions change. Certain investments outperform others. Your carefully constructed portfolio can drift away from your original asset allocation plan. And as I say, I want to talk a little bit about portfolio rebalancing. Most people come into my office, especially when they're getting kind of close to retirement, they kind of put their, most of their investment, your investment may be in your 401k. And even if it's not, even if you have a large IRA that maybe you worked at a prior 401k and you rolled it into an IRA, or you've got an old 401k, or maybe you've got a traditional investment account. And, I found people, they don't really track the investment. They kind of put some time into it at the beginning, maybe. A lot of times with 401ks, you'll do a questionnaire and it'll just kind of assign a portfolio to you, and then we really don't think about it. And so what happens is, over time, our portfolios can get terribly out of balance. And in the last 5 years, with what's happened with the growth in the technology sector and those big mega cap stocks like NVIDIA and Apple and Microsoft and Google and Amazon, it's led to where we've got almost a little bit, are we on a bubble with those big tech stocks? And I don't know that we are, but there's a danger there where, as you're getting closer to retirement, you may be taking more risk than you really realize. Portfolio rebalancing provides essential protection and discipline for an investment strategy. It helps you maintain alignment with your intended risk profile as markets shift. For example, it could be that 5 years ago, you had, a mix of 65% equities, 35% bonds. But now with the explosion the last 5 years in those tech stocks, you may be more like 85% equities. Now, that's been very good for you for 5 years, because the equity market, especially those mega cap stocks, have done very, very, very well. But you're now facing risks that you didn't face 5 years ago. And it's typically important to manage that risk and emotion by sticking to a consistent rebalancing strategy. Now, ideally, when you're rebalancing, what you're doing is periodically, the investments that have done the best for you are now a bigger portion of your investment mix, and the investments that have done more poorly are a smaller portion of your investment mix. And so ultimately, when you rebalance, you're selling off a little bit of the winners, not all of them. You're just bringing them back in balance. And you're buying more of the ones that have not performed well. And emotionally, that can be very counterintuitive. But we know, we're supposed to buy low and sell high, right? Not buy high and sell low. So it helps you maintain consistency with your risk profile. And analyzing investments, you can do it at preset intervals, maybe quarterly or yearly. I will tell you, I'm not a huge fan of automatic quarterly rebalancing. And the reason for that is the research doesn't support it. The research says it can choke off investment momentum. And I'm a big believer in momentum of asset classes. So on the one hand, you don't want a set of investments like mega cap tech stocks to roll forward and you're getting this incredibly superior return. You want to participate in that, but then at some point you do want to curb that back and make sure you don't have too much risk exposure. Now, another idea is to look at the percentages and just track it maybe monthly or quarterly. How much of your money is in large cap growth stocks? How much is in international stocks? And just kind of keep an eye on that. How much is in bonds? And just looking at the overall, what do you have in small caps? Just periodically, maybe once a quarter, look at the balance, the percentages. And when you start to really get out of whack, when you get maybe 5 percentage points different than what your initial balance was, that's when you maybe need to look at it. That's what I'm a fan of, is rebalancing based on feel when you see asset classes get out of balance. And then different approaches can work best at different life stages. It may be you want to allow yourself to be more aggressive with momentum in the early years of your career, in your 20s and 30s, and then you want to become a little bit more balanced in your mid-career. And then as you get close to retirement, you're less positioned to be able to afford, many people as they approach retirement, a 40% downturn in the stock market. But if you've let those tech stocks build up to where they're driving your entire portfolio, that can be a little bit of a concern. So I'll tell you what, we're going to go ahead and get to our first break. Thanks for sticking with us with some of the technology issues. We're going to talk about practical implementation for 2025 and tax-efficient rebalancing strategies. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back. This is More Living here on News Talk 98.7 WOKI. I'm Jim Brogan, and we're talking about spring cleaning. Spring cleaning, this is a great time of year to be refreshing and rebalancing our financial lives. And in that first segment, I was talking about portfolio rebalancing, and this is a common problem that I see. The most common problem is, you kind of set your investment policy, especially inside your 401k or your 403b, and you might look at your statements every quarter, but you're really not actively managing that balance. And I said I don't want you to do that too often, because that can lead to emotional mistakes. Getting constantly in and out of things is not a good idea. And if you rebalance too often, where you sell off some of the winners, you don't sell them off. You pare back the position, right? And then you buy a little bit more of the ones that have not done as well. It is counterintuitive emotionally. But it is important. You don't want to do it too often, but it's important to keep an eye on those things. And as I said, over the last 5 years, it's become a particular problem because of the growth in the technology stocks, those big magnificent seven, we call them, the big mega cap stocks like NVIDIA, Microsoft, Apple, Amazon, those big companies. And so you just got to be careful. And I do want to talk briefly about the challenge with our stock market indexes. And this can be very dangerous. Many of us, we've kind of over the years, we look a lot at the S&P 500, which is an index made up of 500 of the largest U.S. stocks. And then we look at the Dow Jones, which is an index made up of 30 stocks. And those are the ones that are most commonly quoted. There are challenges, especially after the last 5 years with those indices. It's fundamentally important to understand that how that S&P 500 index is calculated. It is not calculated in a way where, and as I said, it's 500 of the largest U.S. companies in the U.S. market, but each company does not have 1/500th of an impact on the movement of that index. In other words, it's not all equal, where each stock has the same impact. The larger a stock is, the more the impact is that it has on that index. And so with these 7 mega cap stocks, they've gotten so big so fast that they're driving, in many cases, they're largely driving the S&P 500. So what's happened is over the last 5 years, the S&P 500 has become a lot more highly correlated to those big mega cap stocks. And that's been good for returns the last 5 years, right? Because those stocks have done so well. But it's created additional risks that we don't realize we're facing. Now, likewise, the Dow Jones is not heavy in the tech stocks. So if all you're doing is tracking the Dow, you're missing out on some of the growth. I mean, you've got some of that in there, but not to the weight you probably want it. So it's important to understand how indexes work, because commonly so many people, they look at how they're doing and they compare that to the index. Or maybe you're just in an S&P 500 fund at work. You have to be very careful with that, especially as you get closer to retirement and can less afford that big 35 to 40% market downturn. Now, when you do rebalance, tax-efficient rebalancing becomes important. Now, if we rebalance inside of our IRA or 401k, we don't have to worry about tax efficiency because we're in a tax shelter, right? Anything that we do inside that IRA or 401k or 403b is sheltered from taxation. So if I sell something that's made money and I buy something else, I don't have a capital gains tax. If it pays a dividend or a capital gain distribution from a fund, I don't have tax exposure because it's sheltered, because that money grows tax deferred. Or if it's a Roth, grows tax free. Now, if I have a traditional investment account that's not inside of an IRA or 401k, every little thing I do has a tax impact. And we do need to think about that. Now, we don't want to let taxes drive the train. That's like the cart pulling the horse. But certainly there can be smarter ways to rebalance with traditional investment accounts that are not retirement accounts. One way would be if you're contributing regularly to your traditional investment account. Again, you're not your IRA, not your 401k. You may want to direct your new contributions to more of the underweight categories rather than selling existing positions because of tax perspectives. Now, when you rebalance, you can also have opportunities with tax planning. And it's important to understand, we do mutual funds. So many people do mutual funds. And it's important to understand how these things are taxed as they grow. If it's a fund that invests in high dividend stocks, when those dividends are paid, those dividends are taxed every year. And remember, there's 2 components of total return. One is the dividend yield, and the other is the growth or the appreciation or depreciation of the stock price. Well, when a stock pays a dividend, the stock price drops. A dividend when it's first paid is net neutral. And if you reinvest that dividend at the end of the day, your investment balance is the same, but the share price has slightly dropped, but you own more shares. So it's a net effect at the end of the day, but there's a taxation effect. Similarly, if you have bond funds, bonds pay regular dividends. And when those dividends are paid, the share price drops. And for a bond fund, most of its total return is driven by dividends. And so what can happen is if you have a joint account or an individual account that's not an IRA or 401k, you have on high dividend funds, like high stock yielding funds or bond funds, you're paying taxes as you go. And you can sometimes, in this case of bond funds, sometimes their total return, they're making more money on their dividends and their share price is actually going down, which means when you rebalance, you could even have a capital loss. So we just want to be smart. Don't let taxes drive the train. But at the same point, we want to be smart about taxes. So understanding that rebalancing inside of a retirement account, no impact on taxes. on your non-IRA account, understanding where you are for tax efficiency and how can you do those rebalances. How can you coordinate that, the non-IRA with the IRA maybe? Keep your whole portfolio in balance without incurring excess tax exposure. But ultimately, we do not want to be holding on to something too long or own too much of it because we're worried we don't want to pay a long-term capital gain. You know, I see that happen all the time. Think about this. You buy a stock for $50,000, and now it's worth $150,000. And you say, Jim, I shouldn't probably have that much in that one stock. Now, that's relative based on the size of your portfolio, but let's say that's too much for one stock. You say, well, I don't want to sell it because I'll have a long-term capital gain if you've held it more than a year. So you bought it for $50. If it's grown $100,000, it's worth $150. So you'd have a $100,000 long-term gain if you sell it. So the problem is emotionally you hang on to it. Well, how long would it take a single growth type stock to lose 30% in a bear market? It could happen in a matter of weeks, right? Certainly over months. Then you lose 30% on $150,000. That's a $45,000 loss. The long-term gains tax on a $100,000 long-term gain for most people is going to be around $15,000, give or take. So do you see where this is upside down? You've held on to a stock. You've now lost $45,000 on it from its high because you didn't want to have to worry about a $15,000 tax. And then you're still owning a stock that has tax exposure if you sell it. So that's where we can get upside down, but we do want to make smart decisions when it comes to tax efficiency. Now, the one other critical thing is, when should you consider cutting loose on a consistently underperforming investment versus continuing to hold it as part of a diversified portfolio? That's an important question because, you know, I've mentioned it's counterintuitive. You have to pare back the funds or the stocks that have done the best, and then you're going to buy more of the ones that have performed more poorly. Well, at what point do you say, you know what, this is an underperforming investment? And I think the most important thing you need to look at there is if you're in funds, mutual funds or ETFs, you know, is it the performance of the underlying asset class that's underperforming, or is that particular fund underperforming? And that's where it's critically important to understand that. Because it may be it's been underperformed because of its asset class, and the last thing you'd want to do is just sell the whole thing. And that's one that you might want to run it back up to its correct balance. You know, maybe it's down to 3%, and you want to take it back to 5% or something like that. But if it's underperforming as a fund, then you've got to look at that too, and maybe it needs to go, and it needs to be replaced with a fund in a similar asset class more than likely, because that's how you should be thinking about your portfolios. Asset allocation is much more important than the actual funds we use. The problem is getting in and out of things, selling things emotionally, buying things emotionally. We typically want to buy things when they're high and sell things when they're low. In rebalancing, you're kind of doing the opposite. So it's just important to keep an eye on exactly how your portfolio is doing, and be sure you're looking at that at least quarterly so that you can be seeing, am I out of balance? Am I taking unnecessary risks? Now, when we come back, we're going to talk about the market outlook moving forward. And we've got a special guest calling in, David Wagner. He is the head of equities at Aptus Capital down in Fairhope, Alabama. We're going to talk about tariffs. We're going to talk about Doge. We're going to talk about inflation, all those things. So stay with us. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living. This is Jim Brogan, where it's all about living the best years of your life your way. You can join us every Saturday from 9 to 10 a.m. and again from 3 to 4 p.m. We're talking about doing a spring refresh. You know, this is the time of year we think about doing spring cleaning. It's a perfect time to refresh and rebalance our financial lives. And I want to talk about the market outlook, and there's so much going on right now. I mean, I can't tell you, just about every client we meet with, everybody comes into office. You know, many are optimistic, many are pessimistic. Some are concerned about tariffs. Some are concerned about laying people off with Doge. There's just so many things going on, and I'm thrilled to have special guest David Wagner, a great friend of the show's over the years, very dear friend of mine. He's the head of equities with Aptus Capital, and you probably see him. He's on about weekly on either CNBC or Fox Business. Good morning, Dave. Welcome to More Living. Great to have you back.
Love being here, Jim.
It's awesome. It's always good to hear your wisdom. Let's talk about what's going on right now. First off, generally speaking, when you look at what has happened since the elections in November, and then how we're off to about almost through the first quarter, what is your assessment of where we've been and where we're heading with our capital markets, and especially with the stock market?
Yeah, Jim, so that's a very important question right now because I think it's kind of a tale of two different cities going on right now. Because fundamentally, the market remains very strong. But the problem that we're seeing on the other side of the coin is that there's a lot of volatility with things going on in Washington, D.C. And Jim, you've heard me talk about, the markets over longer periods of time. And the markets love consistency, and it hates unknown. And right now, we're getting more of the latter than the former. So that's why we started to see some chop in the market. Since February 19th, that was the most recent all-time high for the S&P 500. Since that date, the market has actually pulled back by almost 7%. All right, and that's probably one of the largest pullbacks that we've seen over the last 2 years. So a lot of people are starting to get scared to see if this is something a little bit more structural in the market than just some volatility from what's going on in Washington, D.C. But I think it's really, really important to remind listeners that pullbacks are healthy, they're normal, and they actually happen often. In a given year, the market, as measured by the S&P 500, pulls back 3 different times by 5% or more. And then it pulls back on average 1 time per year of 10% or more. So this just falls into kind of the normal context of intra-year market volatility right now. But obviously, looking through the windshield and not the rear view mirror right now, I think all eyes are going to be on tariffs here in the near term, a little bit of Doge. But I really think that market and investors really need to be focusing on growth of earnings per share of the S&P 500, which is still very, very strong right now.
Yeah, and you mentioned a good point, and I think people have been lulled a little bit into a false sense of confidence because we haven't had a 10% plus correction in the market in over 2 years. So 22 and 23, we didn't see that, or excuse me, 23 and 24, we didn't see that. And so, like you say, usually people don't start getting uncomfortable until we see a 15 to 20% downturn, but now people are getting uncomfortable at 7. So I think it's crucial that we understand perspective of that, David.
Yeah, the wildest thing I've seen here more recently is there's a survey that comes out on a monthly basis, and it's called the AAII survey. And I think to really run down, it's kind of a do as I say, not as I do type of mentality of kind of the results of that survey. Because the survey results, I think it's just witnessed its 7th largest, most bearish or pessimistic print from a sentiment perspective. All right, so that's on the feeling side. But it also comes out with kind of where investors are also kind of placed within the markets. And we're actually seeing one of the largest ever allocations to stocks right now. So you're kind of getting 2 different readings. Do as I say is that people are very much over allocated to securities, not as I feel, because people feel very, very bearish right now. But I think that's to your point, Jim, is that there's that false sense of confidence out there right now because, we really haven't been accustomed to these types of pullbacks over the last 2 or 3 years.
Let's dive into the tariffs. Everybody's talking about it. I've kind of had a little bit, as you know, David, a little bit more of a wait-and-see approach. What's really going to happen? Tariffs were not inflationary, increased tariffs in President Trump's first term. So what's your outlook on what's going on with tariffs, and how concerned should we be about how it affect our markets and our money?
Yeah, I think there's a few really different ways to kind of look at tariffs. And like you said, all eyes are on tariffs right now because that's the headline risk. That's the volatility that's really making the market jump all over the place here recently. And I don't want to give my overall thoughts on if I like tariffs if I disagree with tariffs, if we're actually trying to implement them for pay-fors or as a negotiation tactic. I like to look at it more from a numbers perspective. And I think there's three reasons right now why if we were to implement tariffs right now, there's no better time than to do it right now. And the first reason would be because, the dollar is very, very strong, and a stronger dollar would dilute the impact of tariffs. The second reason would be that the consumer continues to spend at an absolute very high level. Historically, on a year-over-year basis, consumer spending increases 3.5% to 6%. And we're kicking above that weight class right now. We're spending a year-over-year by about 6.5%. And a few partners that we have out there in the market. Yeah, it's a great number. And if these tariffs were to be implemented in the most draconian fashion, that would equate to about a $300 billion consumption tax, or would be a hit to consumer spending by about 1.5%. So if you have that 1.5% haircut to the consumer spending number that we're seeing at 6.5%, puts you at 5%, kind of right in that middle range that we've historically had from 3.5% to 6%. So it's kind of in a Goldilocks area. And I think the third and final right now reason why I think you could implement tariffs, at least officially right now, is that, the S&P 500 continues to grow its earnings per share at a very, very healthy clip. Last quarter, we grew EPS, earnings per share, by 16%. That's very much kicking above its historical range of 7 to 9%. And if all these tariffs were to be implemented into the market, it'd be a haircut to earnings per share by about 2 or 3%. So if you do a little math, carry your one, you can maybe see earnings per share growth being 12 to 13% range, which is just still very much above its historical average. So I don't want to give my thoughts on overall tariffs, but I would say that the market and the consumer right now could very much see a muted impact from the overall tariff ramifications.
Yeah, I think that's important. I think the politicization of where we are as a country right now and where we are in Washington, the media kind of exacerbates these things. And so I think it's important that we don't overreact in the short term. Can you talk a little bit about, when we take risk, a diversified risk portfolio, David, and we're investing, in the short term, fundamentally markets are unpredictable and have the potential, as we've discussed, to be very volatile. Talk about time horizon and understanding the critical importance of being invested when markets are up, but that we never know when those will be.
Absolutely. And so I want to kind of take that time horizon question that you just asked, Jim, and still kind of blend it with tariffs, because that is the topic du jour right now. And Jim, you know me, I'm not political at all. I've written in Ronald Reagan on every single election. And I think taking that type of, opinion, agnostic opinion into the market is the best thing that someone can do. Because if you actually look at...
I want to say, Dave, when we're managing money, we want to be agnostic in terms of politics, right? We want to be looking purely at fundamentals, technicals. Now, we're looking at how something political may affect those things. But we want to be pretty agnostic, right?
Absolutely. You have to be well-rounded. Well, here's a fun statistic for you, Jim. Let's look at the S&P 500 returns by sector under the Trump 1.0 administration, those 4 years, but also the exact same returns of each sector during the 8 years of the Obama administration, pardon me. And I think taking a step back, Obama and Trump couldn't be more polarizing people to each other from a personality perspective, but even more so a policy perspective. And if you look at the sectors that outperformed during Trump 1.0 and during the Obama administration, they're the same exact sectors. It was discretionary, it was tech, and it was healthcare. But on the other side of the spectrum, the sectors that underperformed the most were also identical. It was staples, it was utilities, and it was real estate. So that tells you, if you take a step back, what comes out of Washington, D.C., what policymakers do, the policies that come out of D.C., over longer periods of time, it tends to not matter. Right? It means that what actually drives the market is going to be the fundamental outlook for companies in the United States, the propensity of the consumer to spend, and the overall macroeconomic environment. And from a long-term perspective, that's how we need to look at the market, not on the short-term noise of headline risk that's coming out of tariffs, over the past few weeks. We have to have a long-term look, and at the end of the day, policy doesn't drive the markets, macroeconomic growth does.
That's a great word because, we've looked at the history of markets during different administrations, during different presidencies, when we have split Congress, and the data would show it's the underlying macroeconomic conditions, not policy, that's going to drive that, correct?
Absolutely. And right now, the macroeconomic conditions remain very, very strong, in my opinion. Like I just mentioned, last quarter earnings per share of the S&P 500 grew by 16%. In the first quarter of 2025, it's expected to grow by about 11 or 12%, also very much kicking outside its historical weight class. And CapEx spend continues to happen from the Magnificent Seven. Like just back in October, the CapEx of those 7 companies was supposed to be $293 billion. Now, 4 months later, it's supposed to be $331 billion, an increase of 13%. And someone's CapEx is someone else's revenue. So I would say that, all the narratives that have driven the markets over the last 2 years, well, those structural forces, they remain in place right now.
David, I do want to ask you about the S&P 500 and the mega caps. I spent a good part of the first half hour today talking about not only rebalancing portfolios every so often, not too often, but keeping an eye on our balance, but also some of the problems and dangers of just tracking a single stock index. And we talked about the S&P and the mega caps, and the Dow Jones being less technology oriented. Can you touch a little bit on that?
Yeah, absolutely. So the S&P 500, as you probably just mentioned earlier in the show, the top 10 stocks account for about 39% of the index. And I think that a lot of people out there, they could, take an optimistic opinion to that number or a pessimistic opinion to that number. I actually fall on the side of the ledger. That makes me actually very optimistic. One, yes, I understand that from a concentration perspective, the S&P 500 has never been this concentrated amongst a set of few stocks. But if you actually compare it to the rest of the world, we're one of the most diverse indices relative to European countries' indexes, the emerging markets, really anywhere. But I would say that I'm optimistic about this concentration of these top 10 stocks because the ability that they have a newfound characteristic that I call is called operating leverage. And so for every one input, you get more output, and that's what those companies actually give that newfound characteristic to the S&P 500. And when operating leverage is working for you, it can be your absolute best friend. When it cuts against you, it could be your worst friend. But, in the last 30 seconds here on this answer, what is operating leverage? Well, let's put some numbers, some method to the madness here. That this year in 2025, the S&P 500 is expected to see revenue growth, so top line growth of 5%, but bottom line growth, which is net income, of 15%. So that means for every one input of revenue, you get 3 output of net income. That's operating leverage. For what you put in, you get more out. And it's really those companies that are driving that characteristic of operating leverage. Absolutely.
Yeah, companies are getting more lean. They're cutting expenses. So their revenues are going up some, but they're cutting expenses, and so net's going up even more.
Absolutely. And I think it's reason to be optimistic for the market looking forward.
David, I'd asked you to call in for a segment. We've just got about 10 minutes left in the show. Do you have time to stick with us to the end? I'd love to get into Doge
Absolutely.
and inflation and politics. Okay, we're visiting with David Wagner. We're talking about spring cleaning. It's a great time to get your financial affairs in order. We're talking with David Wagner, head of equities for Aptus Capital. When we come back, we'll have more with him. Again, Doge, inflation. What do you need to be thinking about? So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I do quickly just want to mention my next class is through Pellissippi State Community College through their community outreach. It's on Tuesday, March 25th, and it's tax planning in your retirement. This is tax season. Tax planning, though, is really more looking forward and being intentional about our taxes in the future, because at this point of the time in the year, we're just doing tax preparation. We're looking at things that already happened in 2024, and there's very little we can do other than, add more money to retirement accounts where we're eligible to do that up until April 15th, which many of them were not, like a 401k. Unless it's a solo 401k. So really looking forward is where we can really make an impact. And I think tax planning is going to become more critically important moving forward because we're in such a low tax environment now when you look at us relative to history. So in this class, it's a one-night session for 2 hours, tax planning and your retirement. We'll talk about how you can reduce your tax burden starting now moving forward for the rest of your life. Again, that's Tuesday, March 25th. It's at the Hardin Valley location of Pellissippi State. You can go to PellissippiTaxPlanning.com for more information. It's a 6:30 p.m. class. Again, PellissippiTaxPlanning.com. We're visiting with David Wagner, and I was going to do a segment on budgeting and things like that, but he's so valuable to have on. He's the head of head of equities at Aptus Capital. You also can see him often throughout the week on CNBC and also on Fox Business on TV. And we're talking about the markets moving forward and kind of everything going on in Washington. Help us with perspective, Dave, on Doge. With the amount of layoffs that have happened and may be coming, how significant is this to our workforce? Is this being overblown?
Yeah, so as much as I want to be, altruistic about this entire situation, I try to follow the data and follow the numbers as the rationale to make some types of decisions out there in the market. And we did have some data come out on Thursday in regards to some jobs. It wasn't the non-farm jobs payroll report on Friday, but there's this aspect to this report that's called the Challenger number. And it kind of gives you the gauge of where government jobs, if they increase the number of jobs or decrease the number of jobs. And what that number showed us was that there's about 63,000 layoffs or cuts in the public space under the government umbrella of jobs over the last month or so. And to really peel back the onion and look at that from a materiality perspective and the potential savings that Doge can have. Like, I'm all for Doge. I'm all, to be honest, I'm all for, creating a better balanced budget of some sort. But in the grand scheme of things, it's not as material to cost savings to balancing the budget as maybe the market or news outlets make you seem. At the end of the day, for us to get out of this debt problem that we have of $36 trillion, $28 trillion of that is owed back to the public. The best way to attack the debt problem in this country is to have the ability to grow out of this, not to cut costs. And I think a lot of the programs that Washington, D.C. is trying to put out there, obviously some on the Doge side is to cut costs, but a lot of the fiscal policy coming out is really there to reinvigorate the domestic market, to see that we can actually try to outgrow from a GDP perspective, grow faster than our deficit. And if you can grow from a GDP perspective faster than the deficit out there in the market, you can start to see our overall debt start to come down. And I think that's the main focal point that we need to be focusing on as investors. As much as we want to talk about Doge, in my opinion, it's somewhat immaterial to the grand scheme of things.
You brought up some things I'd really like to unpack, but I have to ask you about the relationship between politics and markets. You had an article you wrote earlier this week, David, that I thought was great. Talk to us about the relationship or not the relationship between politics and markets.
Yeah, there should be no relationship to politics and markets out there. We've all seen the charts, how the market does when a Republican is president, when a Democrat is president, when it's a blue Congress or a red Congress. All the returns tend to smooth out over longer periods of time. And I think that, at the end of the day, politics and what comes out of D.C. is only going to cause volatility. It's not going to drive the market higher or lower over longer periods of time. What's going to do that? It's going to be the fundamental growth of the economy and the propensity of the consumer to spend. And at the end of the day, if you compare, the United States market versus the rest of the world, I truly believe that the domestic U.S. market has such a leg up from a growth perspective relative to the rest of the world, whether it's Europe or emerging markets right now. It makes me optimistic about U.S. domestic markets, no matter what political regimes in Washington, D.C.
David, that's David Wagner.
Don't bet against America, Jim.
Yes, sir. I completely agree with that. That's David Wagner, Aptus Capital. David, thank you for taking time out of your schedule. We'll have you on soon. We'll do a whole show, and we'll really unpack a lot of this stuff, inflation, federal debt, all those things.
God bless everyone, and go Cats.
Go Cats. He's a Kentucky fan. I can't talk this year. They swept us. But we'll see what happens in the NCAA tournament, David. Thank you for tuning in. We've been discussing your wealth because greater wealth provides for more living so you can live the best years of your life your way. Thanks to Wayne for engineering the show, Jill for helping produce the show. Have a very blessed weekend. You've been listening to More Living with Jim Brogan right here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.